Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone.
It's good to be here. And honestly, looking at the stack of research we have to get through, this might be the most complex Monday morning setup we've seen in years.
I would agree with that. It is Monday, January 26, 2026. And, if you're just glancing at your brokerage account this morning, the world looks spectacular.
Oh, absolutely.
Equities are ripping higher, we're seeing fresh records on the major indices, and the momentum feels, well, unstoppable. But as we went through the headlines from CNBC, Bloomberg, and Yahoo Finance, the narrative underneath all that price action is, well, it's disjointed.
Disjointed is putting it mildly. I think the better term is cognitive dissonance. We are seeing a market that is trying to price in two mutually exclusive realities at the exact same time.
That's it. That's the central tension of today's deep dive.
Right.
We have a stock market behaving as if we're entering some golden age of stability and growth.
Right.
But simultaneously, we have gold prices just screaming that the system is breaking. We have winter storm named Fern wreaking havoc on the U.S. energy grid, and we have geopolitical tensions escalating over, of all places, Greenland.
It's a lot to reconcile. And our mission today is to figure out why stock prices are suggesting a perfect world while, bond yields and commodities are suggesting the house is already on fire.
So let's get into the sources. We have to start with the equity side of the equation because the optimism there it's blinding. We're looking at a report from CNBC this morning featuring Timothy Moe, the chief Asia-Pacific equity strategist at Goldman Sachs.
Right, and Moe is looking at the sheer velocity of this rally. I mean, we are less than a month into 2026. The MSCI All Country World Index is already up over 2% this year.
That might sound small, but you have to remember that's on top of, a 20.6% gain in 2025?
Exactly. It's just a straight line up.
It's vertical. And usually when you see a line that's straight on a chart, you expect a pullback, but we just haven't seen one.
No, and that is where the historical context is so vital. Moe points out that over the last few decades, markets typically experience a correction, meaning a drop of at least 10% every 8 to 9 months.
It's like a natural release valve.
It is. It's a natural release of pressure.
Yeah.
But we haven't had a correction in over 9 months now.
But hold on, let me play devil's advocate here. Does the calendar really matter? I mean, just because we usually have a correction doesn't mean we must have one, right?
Yeah.
Maybe the fundamentals actually justify this rally.
And that is the dangerous assumption. The market isn't a machine that follows a set schedule, that's true, but it is a system of risk pricing. When you go this long without a pullback, complacency it sets in. The CNBC report quotes Moe saying the historical clock is ticking.
Okay.
But the most compelling part for me was his analogy for how the correction happens. He calls it a chemistry experiment.
I loved this visual. It's not about a slow erosion of confidence.
No, not at all.
He describes it like titration in a lab. You have a beaker of clear liquid, you add a drop of a reactant, say, some bad geopolitical news, nothing happens.
Still clear.
You add another drop, maybe inflation ticking up, still clear. The liquid looks exactly the same as it did 5 minutes ago.
Right. And all the investors look at the beaker and they say, see? These risks don't matter. The solution is stable.
And then you add one final tiny drop, and instantly the entire beaker turns blue.
That is the perfect description of a nonlinear market reaction. It explains why we're seeing this, this calm right now. The market is absorbing these risks: Greenland, tariffs, debt without flinching.
But that doesn't mean the risks aren't accumulating in the beaker.
Not at all. It just means we haven't hit that saturation point where the color changes.
What's the agent keeping the liquid clear right now?
Right.
Why are traders so confident? The CNBC piece introduced an acronym that I think perfectly captures the psychology of this market. The TACO trade.
Yes, TACO. Trump always chickens out.
It sounds like a joke, but this is apparently a very real trading strategy.
It's the dominant heuristic in the market right now. The theory is really simple. Investors believe that President Trump's aggressive rhetoric, whether it's threatening 100% tariffs or geopolitical ultimatums, is just a negotiation tactic.
It's all posturing.
They assume he will always walk it back at the last minute to cut a deal because he cares too much about the stock market to let it crash.
So the market sees a threat, shrugs, and just buys the dip, assuming it's a bluff.
Exactly. But here is where we get into what Miroslav Aratsky from BCA Research calls the deep paradox. And this is crucial for you to understand. By betting that it's a bluff, the market actually makes the whole situation more dangerous.
Okay, walk me through that logic.
Think about it like parenting, right?
Yeah.
If a child misbehaves and you threaten a timeout but you never actually enforce it, what happens?
The child learns there are no consequences.
Exactly. The child learns they have no boundaries. In the financial world, a market drop is the timeout. It disciplines policymakers. If the S&P 500 tanked 5% every time a dangerous tariff was proposed, the administration would stop proposing them.
But because the market rallies instead.
Because the market rallies, the administration feels validated. They think, look, the market loves this. We have leeway to go even harder. So the lack of market discipline encourages policymakers to pursue even riskier, more destabilizing policies.
That is the paradox. The market's own confidence creates the very conditions for a future crash.
It's a feedback loop of complacency. Precisely. And while the equity market is playing this game of chicken with policymakers, there is another asset class that isn't laughing at the jokes. We need to pivot to the metals market because the numbers coming out of Yahoo Finance and CNBC are signaling something much darker than optimism.
The numbers are startling. Gold has topped $5,100 an ounce. Silver has broken $100. I mean, these aren't just new highs. This is a recalibration of value.
It is, and Robin Brooks from the Brookings Institution, someone who is usually very measured, was quoted calling this rally breathtaking and profoundly scary.
I want to drill down on that word scary. Usually a gold rally is exciting for investors, right? Why is a senior fellow at Brookings terrified by $5,100 gold?
Because of why it is rising. If gold goes up a little bit, it's usually just inflation hedging or, jewelry demand.
Sure.
When it goes parabolic like this, it's what Brooks calls the debasement trade.
The debasement trade. That sounds like we're talking about Roman coins being shaved down.
Mm-hmm.
What does that mean in 2026?
It means the market is losing faith in fiat currency itself. Investors aren't just buying gold to make a profit, they're buying it to exit the dollar and the euro. They're looking at the soaring global government debt, the fiscal irresponsibility in the US and Europe, and they're concluding that the only way governments can deal with this debt is to inflate it away.
So they are effectively voting no confidence in the sustainability of the U.S. fiscal path.
Correct. And it's not just private gold bugs doing this. The CNBC report highlights data from Goldman Sachs showing central bank buying patterns. Before 2022, central banks averaged about 17 tons of gold purchases a month.
And now?
Now they're averaging 60 tons a month. 60. That is a tripling of demand from the very entities that run the financial system. When central banks are frantically trading their own paper reserves for hard assets, they're telling you they expect the paper to lose value.
That connects directly to the geopolitical landscape, doesn't it? If you're a central bank in the global south or Asia, and you see the U.S. weaponizing the dollar or running these massive deficits, you want an asset that no one can sanction or print.
Which brings us to the specific triggers mentioned in the sources. The fear trade is definitely part of this. We have tensions in the Middle East, Venezuela, and now this bizarre but really critical situation in Greenland.
I feel like Greenland is the wild card here. It just keeps popping up in the headlines. The CNBC Daily Open report mentions it as a major source of friction between the U.S. and Europe. Why Greenland? Are we fighting over ice?
We are fighting over position and resources. Greenland is geographically strategic for the Arctic, and it's loaded with rare earth minerals. So the dispute there isn't just diplomatic bickering. It represents a real fracture in the Western alliance. Okay.
The U.S. is pushing hard for influence, and Europe and Canada are pushing back. It adds to that risk-off sentiment.
And speaking of Canada, we can't ignore the headline about the tariff threat. President Trump has threatened a 100% tariff on Canada.
A 100% tariff on your largest trading partner. I mean, that's effectively a trade embargo.
And the condition is very specific. It applies if Canada makes a trade deal with China.
Right. And Canadian PM Mark Carney, quoted in the source, had to walk a very fine line. He stated Canada has no intention of pursuing free trade with non-market economies. But the fact that the threat was made so publicly is the point.
It's the signal it sends.
It's a huge signal. It shows that the U.S. is willing to break the North American supply chain to isolate China. It creates a world where you have to choose sides. You can't just trade with everyone anymore.
And this fragmentation, this whole messy picture, was on full display in Davos. CNBC called it the tale of two Davos.
It really was a split-screen reality.
Yeah.
On one side, you had the optimistic Davos. This was the tech sector, Silicon Valley, the AI crowd.
Right. They were focused entirely on artificial intelligence moving from hype to production. They see a productivity miracle that solves all our debt problems.
Yeah, and on the other side.
The realist Davos. These were the politicians, the bankers, the logistics CEOs. And they were obsessed with tariffs, the Greenland dispute, and the fact that the global rules-based order is, well, it's disintegrating.
And sitting right in the middle of this was China. The report called them the elephant in the room.
It was a fascinating strategic pivot. While the U.S. delegation was making headlines with personal jabs and tariff threats, China sent Vice Premier He Lifeng. And he wasn't there to pound the table. He was there to sell stability.
Which is ironic given the history.
Perhaps, but it was effective. He promoted business opportunities and essentially said, while the West is chaotic and unpredictable, we are open for business. And Larry Fink from BlackRock made a comment that I think sums up the mood perfectly.
What was that?
He said Davos might not always be in the Swiss Alps.
He suggested Detroit or Jakarta.
Right. He did. He called it the mountain coming down to earth. It is a recognition that the center of gravity is shifting away from the old European power centers. Jakarta represents the rising global south. Detroit represents the return to industrial policy. The whole era of the global citizen sipping champagne in Switzerland is fading.
And that shift is creating headaches for central banks, too. Bloomberg has a great breakdown on the Federal Reserve's dilemma this week. We have a rate decision coming up on Wednesday.
And the consensus is a hold. The Fed is expected to keep rates unchanged. But the context around this is just brutal. Bloomberg reports that the Fed is under fierce attack from the White House.
And we aren't just talking about mean tweets.
No, this is legal warfare. Grand jury subpoenas, arguments before the Supreme Court about the president's power to fire Governor Lisa Cook. The Fed is trying to conduct monetary policy while fighting for its own institutional survival.
And while the Fed is paralyzed by this political fight, the rest of the world is scattering. We used to talk about concerted global action. That seems totally dead.
Completely dead. Bloomberg points out the divergence. You have Africa moving toward easing to jumpstart growth. But then look at Latin America. Colombia just hiked minimum wages by 23%.
23%. That's an inflation bomb.
It's huge. So their central bank has to tighten aggressively. Japan is also tightening because inflation is finally sticky there. So you have the U.S. holding, Africa cutting, and LATAM and Japan hiking. There's no coordination. It is every nation for itself trying to manage its own domestic fires.
And speaking of domestic fires, we have to talk about the literal freezing conditions hitting the U.S. right now. The winter storm fern story from CNBC is impacting markets in a very direct way.
This brings us right back to that cognitive dissonance theme. While the stock market is dreaming of an AI utopia, the physical infrastructure is struggling just to keep the lights on. Natural gas prices have jumped 70% in less than 2 weeks.
70%. That is a massive shock for consumers and for heavy industry. And we're seeing stock moves off this. Accelerated Energy is up 28%. ExxonMobil is hitting record highs.
Right.
But why is the price spike so violent? Is it just demand?
It's a supply shock, too. The report details a phenomenon called freeze-offs. It's a technical term, but it's critical to understand.
Okay, explain that for us.
Natural gas coming out of the wellhead isn't pure methane. It contains water vapor. When temperatures drop far enough, that water freezes into ice crystals inside the pipes and valves right at the well site.
So the infrastructure literally chokes itself off.
Exactly. The report estimates we could lose 10 to 80 billion cubic feet of production. So at the exact moment everyone turns up their thermostat, the gas wells stop working. That physical fragility is something the broader market often ignores until it's way too late.
It seems to be the theme of the day. Fragility masked by high prices, whether it's the fragility of the trade relationship with Canada, the fragility of the bond market masked by the taco trade, or the fragility of the power grid masked by energy stock rallies.
That is the synthesis here. The deep dive today reveals a market that is betting on the best-case scenario, that the storm will pass, the tariffs are just bluffs, and the debt doesn't matter.
But the data from that chemistry experiment in the stock market to the $5,100 price tag on gold suggests the beaker is about to change color.
And that brings us back to the taco trade for a final thought. The market assumes that political threats are just leverage. But we have to ask you, what happens on the day the bluff is actually real?
If the market keeps rallying, it removes the safety rail.
Right. The crash won't come from the threat itself. It will come from the market's loss of the ability to price risk correctly. If you assume fire can't burn you, you stop being careful with matches. And right now, between Greenland, the Fed, and the debt, there are a lot of matches being lit.
A sobering but necessary reality check. We will be watching to see if the chemistry experiment holds steady or if we get that phase shift. That is it for today's deep dive. Thank you for listening, and we'll see you all tomorrow morning with new headlines from major financial magazines.